This conference will now be recorded.
Good afternoon and welcome to AI Answers, weekly updates and answers from the world's leading valuation authority. My name is Bill Garber, Director of Government and External Relations for the Appraisal Institute. It is June 10th, 2020, and I'm joined by two appraisers with the Archstone Group, Dennis Duffy, MAI, and Bob Heuner, MAI, and we're going to talk about real estate valuation in a pandemic and some of the issues that appraisal firms are facing supporting their value conclusions and interactions that they are having with clients who are analyzing and looking at COVID-19 real estate propositions and valuation questions. The Archstone Group published a white paper in May that discussed several of these ongoing issues and dynamics in the real estate market. The white paper discusses the concept of value sustainability and tools that appraisers can use to support their conclusions, and ongoing dynamics and issues that are likely to come forward between appraisers and their clients who are struggling and trying to analyze market conditions and market changes that are occurring in the dynamic market that we're living in and seeing evolve today. And we've asked Dennis and Bob to come in and talk and share some of their insights with us, discuss some of the client interactions that they're having, some of the tools that they're starting to incorporate into their daily practices, and some considerations for other appraisers that are dealing with some of these issues and their client base. So Dennis, Bob, welcome to AI Answers. Appreciate your insights today. The floor is yours.
Very good. Thank you, Bill. It's nice of you to invite us to attend today. I'd like to start, if I could, with a brief background as to why the white paper started and some of the issues that we were dealing with in the first part of March when this first became evident, and then about March 13th or so when it officially became a pandemic. The first thing I would say is everything that we're about to say is macro-oriented, meaning everything else on the appraisal side obviously is very specifically targeted to individual properties and individual circumstances. So that said, and appraisers understand this. So from that standpoint, please listen with that mindset. What originated our thought process here was we were seeing significant changes in the way our clients were asking questions relative to addressing the pandemic impact on value. One of the issues that we were hearing about was well, there were two questions. One was, what is the magnitude of the change in value that was anticipated as of, let's call it March? The second was the duration of the impact, adverse impact, as a result of COVID-19. What we were hearing in the press and on TV and among other venues was they were expecting a fairly quick recovery. Once we got this under control, once we got a vaccine, so to speak, the market would recover fairly quickly. Our view of that was unlikely because the magnitude of the pandemic has been universal, not only in the US, but around the world. So that said, how do we as appraisers and analysts understand real estate? First comment is it's a unique asset by definition, as I just mentioned, number one. Number two is we rely and form opinions based on data. All of the conversations that we had during the March period, let's call it, first week in April, were speculation. They were unscientific. They were, I don't want to call them irrational, but I would say panic-oriented. How much are we going to have to write this value down by? And more importantly, from my side, as an analyst, people would call up and ask, Duffy, how are we going to value this thing? My comment to them was, the appraisal community has all sorts of working tools to figure this out. That's the first comment. The second is we have policies and procedures to follow, which will enable us to value properties in any market, whether there's a pandemic or not. So from that standpoint, I wasn't overly concerned with how or what was going to result. I was concerned with the PR and the press that we were going to go through a fairly quick recovery. That from my side was insufficient and a lot of hype. We don't need to deal with that on the appraisal side. We need to deal with facts. So as a result of that, what did we do? We did what any good appraiser would do, which is research, research, research. We tried to find analogous pandemics or market recessions or market corrections, whatever your term might be, in the historical record. We contacted INCREEF in order to do that, because they have the largest database, they have the most consistent database, it's the longest standing database. And we asked how to measure the prior recessions and corrections in the marketplace on a timeline basis with INCREEF data. And we tried to do the same thing in terms of the order of magnitude on a macro level. In addition to that, we broke it down by individual categories: office, retail, apartments, industrial, and so forth. So that was our research, our traditional appraisal tool. That was the first step. The second is obviously to interview participants in the marketplace. We called several of the brokers that we know, see how they were dealing with it. We talked to one or two lenders. I'll come back to the lenders in a minute, just to get their input. One of my broker friends, I can say this as an aside, is I sent him the white paper in draft form. His comment was, "I'm not calling you anymore to do any more appraisal work because it's too negative." So we were kind of laughing about it because I said, "I'm not going to be able to get a seller to get real here. They're gonna go crazy with all this." But anyway, the fact of the matter is, we do what we always do. We research it, we analyze it, we interview sources in the marketplace who are on the front lines, if I can use that common term today, front lines. One of the things that I think we need to consider also in this is, because we have the tools in place, paper deals with very simple tools that appraisers can follow depending on the site-specific factors. Specifically, you'll see in the white paper when you see it, there's 3 or 4 very, very simple steps you and I can deal with very readily without complication. First is a simple present value analysis. Let's assume that the property that we're valuing during this pandemic does not have any material impact directly from the pandemic. A simple present value analysis. Let's say it's worth $10 today, but it's not going to be able to trade because of the pandemic for 6 to 12 months. A simple present value analysis gets us what we need to do. The second is we do a sensitivity analysis. We go through all these steps in a cash flow that we ordinarily would do, and then we adjust individual components within the DCF based on the direct impacts. In other words, the rent, the vacancy, the operating expenses, cap rates, turnover ratios, all the good stuff that everybody on this video understands better than anybody else in the marketplace. So from that standpoint, that's tool number 2. The last thing is, and this gets to the most questions that we got during the March through first part of April time period. Nobody really knew what was going to be the direct impact on the operating side, meaning the rents and the expenses and the cap rates and things like that. Then the question to me is, Duffy, how do we measure this? Because we don't know where the income and expenses are going to shake out. The answer from an appraisal perspective is what? The answer is to look at the rate. If you go back to the mortgage equity technique, you go back to yield capitalization, which Bob will talk about in a few minutes. All of the appraisal tools were created in the 60s and 70s based on an adjustment to the cap rate. Band of investment, equity buildup, change in value, all of those things were simply an adjustment to the old direct cap before we had all the fancy numbers and the fancy math. So my comment to the client base was, all we have to do is adjust the cap rate, but we've got to do it based on some sort of a scientific basis. We just can't do that. We try to measure the additional downtime, things of that type. So from that standpoint, again, the tools are in hand. Fairly recently, a good friend and a peer, certainly, Peter Corbez, had another solution, which is re-verify the sales from the 4th quarter in whatever the asset category is you're dealing with, that you can track with the same buyer and see how they would underwrite their numbers differently. Same sale analysis is another tool. Thank you, Peter, for mentioning that to the Institute a couple weeks ago. So there are any number of tools that we actually have in hand where we don't need to go out and reinvent the wheel. That said, we still have room to get better. We need to raise the bar. We'll come back to that in a minute. What are going to be some of the direct impacts here? Well, it seems to me, obviously, it's case by case. The biggest thing that I am personally worried about is it's going to change how deals are underwritten, and it's going to very seriously impact the equity position. When I interviewed several of the brokers and some of the people that we've been talking to, some of the client base, this is going to shake down to the equity position. The lenders are in pretty good shape financially as compared to 10 years ago when the financial crisis hit. Going back to the early 90s, same thing. The banks and the life companies were getting hammered. They were getting taken down by the feds and put out of business, things of that type. The lending market right now is fairly strong on a capital basis, but we still have to deal with the equity position because that's where the rubber is going to meet the road. The banks have taken steps to shore up their balance sheets. They've taken steps to do pre-bankrupt covenants in their loan documents. They shortened their time horizons. They've done all sorts of things to protect themselves. So they're going to be hurt by this, but they're not going to be hurt anywhere near as much as the equity position. What that means is there is going to be a white knight situation evolving over the next year or two, let's say 2 years, where leveraged properties that have cash flow issues are going to really need to get joint venture partners, white knights, whatever, added equity to salvage their projects. Without question, that is going to impact where we stand. The other thing is one of the mortgage brokers that I talked to had an interesting comment. The lenders will forbear with the proviso of a couple things. One is obviously track record, no question about it. Second thing is, what are the prospects for this deal with these borrowers and these tenants? Assuming the lenders get comfortable with that, the next thing that they want is they want equity coming back into the deal. What does that mean? That's a cash call to the equity position, or it's no distributions for a time period to the equity partners. That's going to change all the numbers. The pricing on all the real estate assets out there is going to change because of the equity repricing in the marketplace. So that's one of the fallouts that we expect as well. One of the things I also want to talk about here are new metrics and new factors to consider. Then I'll turn it over to Bob. Some of the new metrics that we have to focus on from an appraisal perspective, I think in more detail than we have in the past, would be unemployment and the default ratio. We can see those numbers out there. They're published by various vendors and various forums. So that's a good thing. We have access to that data. The reason that unemployment to me is particularly of import now is the fact that bodies create demand. Industrial space has bodies. Retail space has bodies. Hotels have bodies. If we're going to be downsizing our office use, we're going to be downsizing our retail use because so many retailers are out of business. That is a demand factor, which to me is going to be extremely different from where it was in 2010. 1995 or any of these other time periods that we identified in our white paper. I think there's going to be constraint on that. I think there's going to be less demand. And even if you do a simple math calculation, I'm a percentage guy. If we have 100% inventory and 30 to 40% are working remotely, Bill Garber and I were joking earlier about working remotely here, and 30 to 40% of those people continue to work remotely, even on a part-time basis. And even if we add a 20% factor for the social distancing moving forward, that's a net 10 to 20% erosion in demand for office space. Somewhere around 25 to 40% of the retailers are gone. Retail has got, that's a 10 to 15% spike in retail occupancy nationally, globally, that is going away. So how do we then underwrite and value retail properties knowing that we're going to have a structural vacancy of 15 to 20% on top of whatever it is now, 5, 6, 8, 10%? That's something that we're going to have to deal with. I think the best measurement in that will be looking at unemployment figures, more so in detail than we used to, probably by job sector, so that we can get a good read. Then we get into the submarket information, meaning DC, New York, Chicago, things like that, where we can look at the employment demand moving forward. And we're going to have to really monitor that because clients are going to be asking And then finally, from the standpoint of new metrics, in my opinion, we have a scenario here where we have a lot of standing inventory. Forget the demand side. Now I'm talking about the supply side. We have a lot of standing inventory that's going to require a lot of repositioning. That's in the form of either physically being demanded by the marketplace or alternatively from a highest and best use standpoint that we have not had to deal with in the past. We need to do that. We also need to have better regulations. We need to change zoning. We need to have buildings that are built flexibly so that you can have an office building that converts to a multifamily, to a hotel, and so forth, all of which are frictional costs, meaning specifically time and cost to convert to an alternate use. Land is being gobbled up at a fast rate. We're going to have to reuse what we have. We need environmental sustainability. There's any number of issues out there that real estate can address, but it's a time and cost item. That's going to impact how we value these properties. We are going to have to be much more attuned to highest and best use and the conversion cost factor, more so than we have had to do that in the past. Again, that gets to value sustainability. I'm going to turn the microphone over now to Bob Heuner, one of my partners on this, and he's going to address a new tool that is an old tool, and that is yield capitalization, which is targeted to understand how value is sustainable based on the items that we've just discussed. Bob?
Hey, Dennis, thank you. Thank you, Bill. Yeah, as Dennis said, sustainable value is not a new concept. It should be familiar to everybody. It's talked specifically about in Guide Notes 10 and 12 of USPAP, both of which deal with changing market trends or developing an opinion of value in the aftermath of a disaster, whether COVID-19 or some natural event. There are going to be these valuation questions or issues, probably unlike what we've seen in the last few months. This is somewhat unique in my opinion. But what Dennis said here is, in the last few minutes, is particularly caught my ear, that all these things considered, what do I do when I have to turn in my appraisal today? I need to give the lender a value today. How do these events impact that value going forward? The truth is, our feet have really not been held to the fire to produce that type of amendment or addendum to our reports. And yet it's critical to underwrite these properties in a smart way. Now, I do believe that part of the issue in the past is that sustainable value has been looked at from different perspectives. Some people look at it as an underwriting tool, other people a risk management tool. The appraisal community, I don't believe, has embraced it as widely as they should, because it's a way to protect yourself a bit from liability here. And frankly, as Dennis said, this is not new or voodoo math. This is an old concept with new applications. Yield capitalization on a stabilized asset at market rents is a forward-looking way to determine a likely or probable outcome to the investor. The primary goal of this model that we use today is not to poke holes in any appraisal. While it can be used as a review tool, a quality assurance measure, even in testimony settings, that's not the goal. The goal is to take your appraised value, and in practice, our widest user base right now are appraisers who are looking to support their estimate of value, to build credibility, do quality assurance, internal reviews, but then to offer some caution about what may happen once you drive that car off the lot. Once the lender accepts your report as credible, is he sitting on a ticking time bomb that's going to crash? Now, in practice, it's hard. You cannot define a specific outcome, but you can rate for probability the chance of an event happening. And that's basically what we're doing here. Now, sustainable value is not new. However, a model was developed by an MAI in California named Ray Dozier. He created this model. He termed it value expose. It's a yield capitalization forecast, and it keys in on the all cash yield rate that investors are using. Well, that is applied in place of a residual or terminal rate which will help you filter out the market noise and purge that that reversion rate of any market exuberance or irrational fear. And that's always a weakness or a choke point for subjectivity in most appraisals, is that residual rate. Now, by doing that, we're able to plot multiple points. We have our starting appraised value and our likely, what we're terming a fundamental reversion value, which is nothing but the reversion capped at the all cash yield rate. Once you plot those two numbers, a third figure would be what the market is plotting as a likely reversion based on your going in anticipated yield. Now that spread will tell you your best and worst case scenarios. I really shouldn't call fundamental value or reversion a worst case scenario. Sometimes it's not. This can be used to spot market bubbles, but can also be a super effective way to spot buy side opportunities. It's as you let's put it this way: the tendency of a value over a hold period will be to trail either down or up towards that fundamental reversion. And just for this discussion, let's put an 80-20 rule on this, where you have an 80% probability of trending towards your fundamental reversion value and its corresponding yield. So I do realize that investor tolerance for yield erosion or value change is very individualistic. That said, we can plot the points where your likely outcome is going to fall and its corresponding yield. If you go into a deal, a loan, any kind of an offering here, and you're presetting your parameters at an 8% yield, yet your fundamental reversion is going to trail off and hit somewhere around 4 to 5%. That's a decision that the investor now has to make, because is that, not only is that value resilient, but is that yield going to hold up? And this is now, when we're looking at a one-off property, this is a way to measure what happens to yield and value. When we apply the same concept to either a comparison of offerings or portfolio, we can see our best and worst in class. We can also compare apples to apples for which one do I want? Do I want the one that's been on the shelf that's going to spoil in 2 days? Or do I want that one that's going to stay resilient and healthy for 7 days? And this is how we're now applying sustainable value. Again, the math is not new. This has been around, as Dennis said, for years, decades, in fact. I believe that sustainable value is time to dust it off and pull it out of the closet, because it's very applicable in the current environment. COVID-19 notwithstanding, there are going to be other events. And one thing that we should key in on here is, as appraisers, how do you stand in the field and choose a direction to walk or move? You can't stand still, at least not for too long. So instead of just back of the napkin discounting or tying an adjustment to any of your rates via observational tools, I'm suggesting this credible mathematical model. It's a supportable way to defend yourself and your opinions of value. And it also is a very effective way to stay in more compliance with USPAP, just to avoid any issues that may result from reporting a value. And as Dennis said, we're both working on these shopping centers where we've been requested to look at value pre-COVID and post-COVID. I've talked to other appraisers who are getting requests for 3, 4, 5 different value options, depending on the recovery scenario. Now that's also an interesting offshoot here, or vertical, I'll call it, is that this model has built-in sensitivities to preset parameters. So in plain language, we have this structure that we can create sensitivities to multiple recovery options, whether it's a V shape, a U shape, Nike whoosh. I've heard that term. Under normal market conditions, you would just forecast your assumptions going forward. So it's an incredibly scalable tool that can be used on a one-off portfolio or property grouping basis. And I will say as well that it's very applicable in the lending side. We should be aware of this as appraisers because lenders are going to migrate towards this tool as a way to stress test value. Our appraised value for our purposes today is an assumed credible starting point. However, in this model, if I decide to substitute an alternate going in value, I can also stress test what's going on with my outgoing yields. And it just gives me a way to reverse engineer an opinion of your work product. These things are going to become more common in underwriting practice, and hopefully they become widespread in the appraisal community, because I do believe we're fighting a battle here to get to the lowest fee and the fastest timing. And the hard truth is that appraisers really are not going to be able to compete with the technology that's developing. I know that I've seen AVM models that appear, at least on the surface, to be credible. They're very flashy. They have a lot of data, but what they're missing is that human element, which is why people hire us. A car mechanic could run these AVM models, right? He just plugs in the assumptions from a survey and out goes a report. You can't tell whether this guy is 20 years, 30 years in the appraisal business, or he has been a car mechanic for 20 years. However, with these tools, these new approaches to advising our clients, to bettering our credibility and supporting our values, I think this gives us an advantage over those AVM type approaches. And I can only tell you that speed or turnaround times are just going to get shorter and shorter as the technology improves. The only answer to remain relevant and to capture market share against some of these other competitors is to offer some things that they don't have. And I can tell you that this concept is not currently in the AVM world per se. It may be soon. I can tell you that if they don't embrace this, or if lenders don't embrace this in a wide scale way, as Dennis said, we are going to migrate towards that over leveraged environment again, just as we have over and over in the past. I would encourage your listeners, Bill, to just take a quick read through Guide Notes 10 and 12, and you'll see the language there is very plain. I do realize that the guide notes sit outside USPAP, so some people may view these as a non-requirement, but maybe a bell or a whistle. But I would say that to me, the idea of reporting a value, but knowing that I have tremendous exposure over my likely hold period, and not cautioning that lender or that client, to me, that is a bit misleading, more than a bit, actually. And even if this is an internal run and gives you a talking point or a way to open a door to a new client, I would advise at least exploring this technique. And I can tell you, if the questions come up later, this is a tremendous upside opportunity to market your services. There's a lot of throw-off services that splinter off of this model. And I'll leave it at that. I don't want to over pitch this, but the idea is mathematically sound, and it's a credible tool. It's a way for us to maintain relevance in this highly competitive, burgeoning technology environment.
Yeah, I've heard a couple of chief appraisers say on this program that they really want and are encouraging appraisers to lean into the market and utilize their experience and their expertise. It sounds like you're responding to that with some everything under the guise of everything old is new again. This value sustainability construct.
Well, without a doubt, the competitive advantage of the human being and I should say the experienced appraiser, not just a human being, is our experience, right? The model is just a cold, efficient machine that will crank out a number. That number may be tied to data sets, but it can't possibly benefit from the experience of the guy driving the car, or the woman driving the car. It's experience is what gives us an advantage, and I think we can maintain that at least into the short term. These AVMs are getting stronger and stronger, so it's critical that we build our relevance now.
So can I ask, how are you reporting values in the COVID-19 era?
Bob, if it's okay, I'll do that one. We're doing at least 2 values, Bill. We're doing, if you will, a stabilized or a pre-COVID impact, as it turns out here. And then we're also reporting per the USPAP requirements, per the Appraisal Institute's guidance from a couple months ago. We put in the report in 3 different areas what we believe the COVID impact is on subject property X, whatever that is. It'll be in the transmittal letter, it'll be in the reconciliation, and then it'll be in wherever it is most pertinent in the 3 approaches to value. Could be a rent issue on this particular property. On another property, it might be more impactful on the sales side. So we put it in 3 parts of our report, and we report multiple numbers depending on what the scope of the assignment is.
How have the clients received that arrangement and the communication? How has that been, and has there been any sticking point?
The best answer I can give you there is I think they get it, they understand it. The way I would say it from my side as an appraiser, in the couple of cases that we've done for lenders recently, they were very insistent on quantifying the impact. I don't think anybody knows what the current impact is because we're 30, 60 days into the pandemic. We state that in there, we send the report in, they send it back, we need a number. So from that standpoint, even though we've defined whatever the risk factors are on a line-by-line basis, in a couple of the cases, they still want a number attached to it. The good news so far is on the ones that they've come back to us on, they're stabilized properties, they're deals, they're estate-oriented properties, so I really haven't had to deal with it that intensively, but I can tell you that the one deal that we did do in the last week and a half with a lender, they wanted a number, and from my side, that's very difficult. The good news in that case is we assigned a 0 to 5% value swing on it because they had full occupancy, they had credit tenants, they had duration on the leases, which will carry us past the pandemic. So from that standpoint, we didn't expect, and it's on top of a metro stop. So from that standpoint, it's not going to be that adversely impacted compared to other assets.
Bob, anything further on that?
Yeah, well, it's an interesting question, actually. From what I've seen, these lenders are actually as kind of in the dark as everybody. They're out there asking for these multiple scenario values to try to cover their own perspectives. And frankly, because they don't have the ability on their desktop to stress test these numbers under different recovery assumptions. And right. I do believe this is one of the key features here is that, if you can imagine this as a football, once we run our models, we can pass a digital football off to that lender and give them the ability to stress test under multiple scenarios what's going to happen. Takes a little bit of pressure off, like Dennis said. When these lenders want to drill down to a single point of value, that's where you really face risk, right? I mean, we can actually report a corridor value, and then rate that corridor in terms of probability. And frankly, in today's environment, that may be the appropriate way to go for everybody concerned. But the lenders now are trying to answer every option, every question, and they're placing a huge burden on the appraisal community for that.
I would imagine some of these concepts have wide applicability to a range of client types, not just lenders, but institutional investors, and we're saying the purchase and real estate developers and the like. Are you seeing this be received there as well?
Oh,
yes, absolutely.
Yeah, without a doubt. I mean, it's just a fascinating way to use technology, but still drive it with the experience of the guy in the field. We can actually take a single asset, or we can group a portfolio all from a single desktop. You know, we can preset hundreds, literally, of parameters for recovery or forecast. You know, predictive analytics have been a buzzword now for years, but they're actually here. I would say I would drill that down to 3 to 4 scenarios, which everybody right now is thinking about. Are we in a V-shaped recovery, a U-shape, or a Nike whoosh, a checkmark type recovery? And assuming you want to tweak any one of those for best, worst, and likely scenario, you can. It would take the normal user 5 minutes to set master assumptions under any of those scenarios and apply them across an entire portfolio. And just by way of example, if you look at the REITs, we are actually engaged by several of these REITs to give them that exact functionality and to plot based on these assumptions when that original baseline value is likely to recover. And as you can tell, you know, as you can imagine, there's quite a few interested parties in that type of information, whether it's, you know, a REIT stock investor or an actual buyer or seller. So this has a huge range of utility.
For a reader of this type of report and information, what do you point to as the most important factors to consider?
Well, as I said, investor tolerance to loss or yield erosion is a very individualistic thing. So the whole approach, the whole purpose of this report is to make that transparent. What's likely to occur? Now, if you're talking to a broker community, that's different. We can actually group investment options. Like if Dennis came across a portfolio of 20 shopping centers, we can plot them one after the other, and then we can show you which are the strongest in the field, best in class, versus the ones the most likely to erode down to the low end of the yield range. And that of course is simply a buy or not buy decision. So the trick is to look at our time-tested mathematical models and just find new ways to become useful, really. The ability to do mass screenings like this from a single desktop simply hasn't existed before. Or, well, I shouldn't say that. The technology has existed, but the desire to do this and the ability to focus data this way is brand new, but it's here now.
So we're a couple of months into COVID-19. What are the most important points to raise in evaluating market changes from COVID?
Dennis, why don't you take that one?
It seems to me, Bill, there's a couple of things that are very important moving forward. What I'm hearing from my clients is they're very concerned about the viability of the tenant base. If you remember earlier, I spoke about the unemployment rate as an example. There's going to be a shakeout in the number of bodies in every industry. The way I've defined it elsewhere, not in this document, I don't believe, but in other documents that we prepared, we are undergoing the industrialization of the white collar workforce, as opposed to the blue collar situation several years ago, 50 years ago, when the automation came into the auto industry, among other places. We're seeing that now in the white collar space. So I think the sustainability of the tenant and how that tenant is going to respond to the COVID pandemic is really what's going to drive the underwriting moving forward. Have landlords underwritten tenant strength in the past? Yes. But I think it's not only going to be the number of what those financial records indicate, but it's going to be their viability and their adaptability to deal with technology, what that's going to do to their business model. The other thing that I would say there is we really need to focus on the ability to be flexible, not only in terms of our staffing, which is the demand side of it, but the building side of it. We're going to be tasked with redesigning our entire concept, zoning, Municipalities are going to go through a tremendous amount of stress with tax appeals. So they're going to have to get more creative on how they deal with space out in the marketplace, things like that, which we've never really had to deal with. We deal with it, but it's more ad hoc and it's certainly not structural. The time for that inefficiency is over.
You can't do that one overnight, though.
Can't do it overnight. That's why it's a time and cost perspective.
Right. Yeah, unfortunately, that one's going to take months, if not years, to implement.
Well, it is, and it's a political process. It's got to go through all those kind of hoops, and everybody wants their say about the new project or the renovation down the street, things like that. There's no question that it's going to be controversial, none at all.
Right.
But it still is going to have to happen because there's no other option. We can't go further out on the prairie. The resources are dwindling, they're getting compromised. We don't have the money to spend to go out and create all this new infrastructure. So we're going to have to be smarter and use the assets that we currently have, just as in this case, we're talking about using appraisal tools smarter than we used to. That's what we're saying here.
At this point, can you say that project that there may be any winners in the real estate space from COVID-19? We've heard a lot about logistics as one area that's seen heightened attention. What are your thoughts about any upside, any winning market segments?
From my side, obviously, the logistics makes some sense. I also think the apartments, after a bit of a shakedown the next 12 months, call it, I think the apartments are going to win because people are going to look for their alternate office, if I could say it that way, more so than they have in the past. I think those two assets in particular, and then the triple net lease space is very good. All that stuff is being passed to the tenants. We're doing ground leases now that are 10-year ground leases. Ground leases used to be 50 to 100 years. And the reason is the tenants are trying not to lock into long-term ground lease costs. And the economic life of buildings is getting shorter and shorter. We're now demolishing stadiums in many cities around the country that were built 20 to 30 years ago. Why? Highest and best use has changed. So the live, work, play matrix, I think, is going to be the next wave. We're going to see more of this urban LA sprawl, if I could say it that way. Everything is going to get more mixed use on a wider geographic spread basis. I think that's really what we've got to be prepared for, and that's why we've got to be flexible in our zoning. Bob?
Yeah, it's an interesting perspective question from my point of view. I see winners in the COVID environment. I don't so much see that as much as people hanging on by their fingers. The winners, to me, I would say the better survivors are exactly what Dennis just said. You know, there's certain properties that are going to be more what's the right word? I guess just resilient in the face of these conditions. However, the amount of opportunity fund money out there right now is, to me, those guys are in the space where they're just poised to pull down huge returns. Just by way of a quick example, the hotel REITs, according to TREP, as of, I believe it was mid-April, had taken a beating of 50 to 80% of their retail price, but their NOI loss was not nearly that far. You know, these groups are poised. They actually are poised to bounce back at some point, and I know that's a market by market thing, particularly in the hotel segment. But if you're on the right side of this return or recovery, and you can at least plot the probability of a recovery, the baseline, the amount of return you can make now is just unlimited. And I know there's just massive amounts of capital waiting for these exact opportunities. So I do see the investor crowd as the winners here. And look, down the road, there's going to be a lag time, but the appraisal community is certainly going to benefit from the increase in workflow. But I do believe there's going to be a lag, at least 6 to 12 months, before we see that type of finance work bounce back.
Yeah, in the meantime, it's probably a good deal of asset management and special servicing work to come to appraisers as everybody tries to deal with the various fallout that lies ahead.
Yeah, no doubt, and that just, you know, it makes it critical for our community to seek out other verticals, other ways we can maintain our relevance in this environment. Appraisers are skilled across several specialties, and I think it's time to leverage those. You know, beyond just the typical hand me the appraisal and go away. I think we can expand our role in this type of market.
Absolutely. How are you evaluating some of the various lender forbearance programs that we're hearing and seeing activate and really be leaned on, at least for the first couple of months, the last couple of months?
A couple of things there, Bill. One is early in April, we were just told by a couple of our clients, everybody was 30 days standstill, nothing happening. More recently, let's call it the middle of May or so, that expanded to 90 days as opposed to 30 days. I'm starting to hear that they're now talking about a standstill for 6 months. Why? Everybody is struggling with accurately forecasting the income and expenses for every tenant, every business, everywhere. So I think that's the first comment I would make there. Thereafter, then it gets into handicap. I was talking to one of the landlords, what's today, Wednesday, Monday, and they're trying to figure out how to underwrite the successful retail. This is a shopping center owner. Successful retailers on the backside of this COVID thing. How are they going to underwrite a winner? How are they going to deal with losers? What's their parameter here? So I think that's really going to be the trick. The trick moving forward is to underwrite the likely successful businesses moving forward. I think that's really going to be, without question, the hardest thing to do. That deals with people, and people are hard to read and judge and quantify.
Bob, any thoughts on that?
Well, like Dennis said, you know, as we move forward through this, so you know, the right word is a blind spot. The only thing we can do is model expectations. The good news is that we do have the ability to do that and judge the impact in a supportable way, in a mathematically credible way. We can do this. It's not a guess. It's a projection, a market supported projection. Very different terms, right? Some people in practice today, when they get asked about what's the impact of this or what's the impact of that, they'll have a reflexive response. I don't think that's the best approach. I think the way is to thoughtfully walk through a change in assumption and to run things through an accepted model or practice. Doesn't have to be a yield capitalization, could be whatever model you're comfortable with. But I encourage you to go back and look at what these old concepts actually have new applicability, and they can be focused on particular problems. So I do believe that this is going to happen more and more. We're going to niche off into areas and very specific questions like the ones you're bringing up here.
What are your initial observations about the landlord forbearance that we're seeing, the activity that we're seeing there in COVID-19?
Landlords, from the few that I've talked to over the last 30 days or so, they're not giving free rent. Tenants are going to have to pay the rent, period. They might extend the lease term, but the forbearance period, whatever it is, let's call it 90 days. If you're an office tenant, maybe you get 90 days. That rent, you're not going to get for free. You're going to pay it back with some interest, or you're going to have to extend your lease and get the rent paid back that way. So the first thing I would say, any landlord I've talked to, zero free rent. It's just deferred, delayed, whatever. Then the other thing is, again, this handicapping of who's going to be successful and who's not. And then last but not least, some of the things which I hadn't really thought about, and it just hit me when you asked the question. Some of the landlords are trying to figure out how to reutilize some of their space. In the retail case, we've seen this in the past where it used to be a toy store, let's say. Well, now it's a medical clinic, or it's a service kind of thing, or an office thing. The same would apply with hotels. Some of them are going to condo out some of the spaces. So I think the way I would say it is some of the landlords are just now starting to look at alternate uses, even if it's only part of the space. Then we get into the zoning thing. Well, is that permitted? Is it not permitted? Things like that. But I think the really, really good landlords are going to be very creative. For all these years I've been doing this, the development community is extremely creative. They will do everything they can to maximize dollars 100% of the time for 100% of the space.
Bob,
You know, if I could,
go ahead, Bob.
I was just going to add one thought to that. You know, it is an interesting development that landlords are going to hold their positions and not forgive rent. I think their position is untenable. If they forgive rent, they're just going to create a pattern. Not only that affects the current tenant expectations, but it's certainly going to affect their value, right? They're going to have to report their quarterly earnings or their annual statements, and it's certainly going to ding them in terms of credit. However, as you play this out to its logical conclusion, if I'm not forgiving you rent, but I'm just adding on half of what you owe me to next month, I'm creating that above market position that's just going to weigh down the risk on that space. Now, you know, again, Dennis and I deal a lot with these credit tenants that maybe this isn't such an issue, but when you're talking about an inline, some small to mid-size user, restaurant, mom and pop place, you know, this is an unbearable weight after a certain time. And I just don't see that as a permanent solution. I see that as a cross your fingers and hope this works type approach to rent recovery or maintaining a certain level. So, you know, I'm hopeful too. I do hope they recoup their rents, but I just don't see that as a sustainable management perspective.
Yeah, some of this is hard to contemplate. We're seeing such a fundamental change and adjustment in how we're using property. There's a fissure that's occurred in all of this throughout business and life altogether.
Yeah.
I mean, the changes are immense and almost just hard to envision.
One of those things, Bill, if I could just follow up on that, I think the retail industry as a macro entity, they're very, very good at underwriting their rents. Why? Because they do their rents as a retailer, a toy store or a card store or a pizza place. They pay rent based on their gross revenues for that operation. And usually it's a very narrow range of ratio relative to the sales volume per square foot. I think that's going to impact offices. I think it's going to impact industrial space. I think it's going to impact the entire market for that reason that you're talking about. They have to be sustainable and they have to be able to figure out what they now can afford to do moving forward. All these retailers that are shut down, unfortunately, especially restaurants, at 50% operations, I'm scratching my head saying, how are they going to possibly pay the rent, even when COVID-19 evaporates? They're just not going to be able to do that. Meanwhile, office tenants have just signed, well, the rent's $40 a square foot, and that's the answer. Not anymore, it's not. They're going to have to say, well, if it's $40, that's so many dollars. What is my gross billings for my office or gross revenue for my office? All of those other tenant categories are going to get way smarter on how they negotiate their rents moving forward, is my point.
Now, there's been some changes in accounting regulations or standards in the banking sector. There's something called the current expected credit losses, or Cecil standards, that are replacing the old allowance for loan and lease losses. Do you see any applicability for your constructs that you're advocating for in the Cecil construct?
Yeah, absolutely. This is really tailor-made to address that question. The problem with the answer here is that Cecil as yet is not you can't boil it down to a single formula. Believe me, I've tried, because I'd like to work that formula right into this model. Right now, it does appear that the reserve requirements are, I don't believe they're even fully finalized yet, but they're moving by a common practice mentality. So it's until we get a bit of clarity on this, I don't think we're going to be able to drill down to an exact correlation between what happens when this asset or portfolio dips toward fundamental reversion level and the amount of reserves we're required to hold back. I do believe that's a question that'll become very prevalent in the near term, but in the middle of this, call it what you will, a pandemic, chaos, we call it a blind spot because you need some guidance. There just isn't that clarity. And for me to speak to a specific ratio or way to correlate that number, I'd be off key here. I would say we'll revisit this in the near term and try and drill down to the answer that you need.
Yeah, that makes sense. Potential opportunity down the line. Well, guys, tell us where we can find more information on your white paper and any parting thoughts or recommendations for valuation professionals.
Bob, why don't you go first?
Okay, well, we'll certainly make this available in the most convenient way, either via AI or Bill through you and your site. My advice, I would just part with this. I would definitely take a look at these different tools and see if you can use them. They're not hard to understand. They're easy to use and very time efficient. You'll be able to scale your workflow if you focus in a segment. I would tend to move a little bit away from the idea of more is better in the written sense. The evolution of appraisal is not necessarily just to add more and more data, pages, references, but to streamline and create a credible, supportable argument. I would actually suggest that you step back from the normal client base that you have. If I came from a 90% financing shop background, and once I stepped out of that role, I realized what else is available, what else is out there, what niche consulting services we can offer, how I can customize certain models I've always had, and talk to new clients. Even if you looked at this as a door opener or door knocker or a way to upsell appraisal services, not appraisals, I would encourage you to do so. This is we not only do we need the business at this point in time, it's a great time to look at alternate paths. Appraisal work is changing. It doesn't have to be viewed as a negative. Technology is not a negative or something to be feared. It's something to be used. And I think we can use it to our benefit and enhance our role.
Dennis?
If I could add one other comment to Bob, actually two comments to Bob's view, which I agree with. Number one is, I did mention earlier, and I should have, one of the concerns I have with just the macro economy post-COVID is everybody's going to be scrambling for cash flow in all businesses, and whatever industry you're in. I have it in my notes, but I didn't mention it previously, and that is that we're borrowing from the future here. We're going to be, all these companies are going to be reducing their research and development capabilities. And if they're in the medical technology business, the medical profession, the appraisal business, we're not going to have the revenues needed to invest in the future. We're going to have to really look hard and long at that. Technology, as Bob said, is going to be one of those solutions. So we really, really need to, as an industry and as an economy, macro economy, US economy, we're going to really have to sacrifice near term to invest in the R&D part of our world, whatever that means. And then the other thing is getting back to our skills. It seems to me, and it kind of amazes me. It's a very Jekyll and Hyde scenario. One is on the one side, you guys are just appraisers. You guys don't know what you're doing. You guys are behind the curve. You look at sales from 5 years ago. Who cares? What I would say there is, who was the first guy they called in March? They didn't call the computer. They didn't call, somebody else. They called the old guy who has experience, who has the tools to do the work and the understanding how to apply the tools. As an industry, I think we get shortchanged in a lot of ways. My comment to that is we should be proactive. We should be confirmed in our belief that we have the mechanical tools to do that and the skills. And if we listen, the key point here is this: we have to listen to the marketplace and our client base. If we're educated, we have to continually educate. No computer is going to replace Bill Garber. No computer is going to replace Duffy. No computer is going to replace Bob Heuner. But we have to be educated and we have to be good at what we do.
I don't know about that for me, guys, but sure. Trust it for those appraisers out there. I do agree. This is a great time to be an appraiser, and it's an opportunity for the appraisal profession to really shine and stand out in the marketplace, because the services are needed more now than they were ever before. I'd like to thank both of you for coming on to AI Answers today. Dennis Duffy, MAI, and Bob Heuner, MAI, with the Archstone. We will post their white paper as a footnote to the social media accounts where our video is found. Gentlemen, thank you so much for joining me today. And to our listeners, please stay safe. We'll see you next week.
Thank you, Bill.
Thank you, Bill.